What if I told you that a single decision made behind closed doors in Washington could quietly change your mortgage payment, your grocery bill, your job security, and even the price of gold in your retirement account, almost overnight? What if I told you that the most powerful force behind your money is not your bank, not Wall Street, but a small group of people who meet 8 times a year and speak in carefully chosen words that move trillions of dollars in seconds? Today, we're pulling back the curtain on the US dollar and Federal Reserve policy, and by the end of this video, you will never hear the words interest rate hike the same way again. Welcome to the Gold Report, where we break down the forces shaping your money and your future in a way that's simple, clear, and real. And before we go any further, if you care about protecting your wealth and understanding what's really happening behind the headlines, take a second right now to like this video and subscribe to the channel. It helps us reach more people, and it tells us you want more deep, honest breakdowns like this. Let's start with something simple. The US dollar is not just paper. It's not just numbers in your bank app. It's the world's reserve currency. That means countries around the globe hold dollars to trade oil, to settle debts, to stabilize their own currencies. When the US dollar moves, the world feels it. And the Federal Reserve, often just called the Fed, is the institution that controls the supply and cost of that dollar. The Fed doesn't print money in the way people imagine, but it does control monetary policy. It sets the federal funds rate, it manages liquidity, and it influences how much it costs to borrow money across the entire economy. Think of the Fed as the thermostat of the US economy. If inflation gets too hot, they turn up interest rates to cool things down. If unemployment rises and growth slows, they lower rates to stimulate borrowing and spending. Sounds simple, right? But here's where it gets interesting. Every move the Fed makes has ripple effects. When interest rates rise, credit card payments increase, mortgage rates climb, business loans become more expensive, and suddenly families start cutting back. Businesses slow hiring. Investors shift money out of risk assets and into safer ones. And the US dollar often strengthens because higher interest rates attract global capital. Now imagine the opposite. When the Fed lowers rates, borrowing becomes cheaper. People buy homes, companies expand, markets rally, and risk appetite grows. But there's a trade-off. Lower rates can weaken the dollar and fuel inflation if done for too long. This balancing act is at the core of Federal Reserve policy. And it's never just about numbers. It's about psychology. It's about expectations. It's about trust. One of the most powerful tools the Fed uses isn't even the rate itself. It's forward guidance. That means what they say about what they might do next. A single sentence in a press conference can cause the stock market to surge or crash. Investors hang on every word from the Fed chair because markets move on expectations, not just actions. If investors believe rates will stay high for longer, they adjust today. If they believe cuts are coming soon, they position early. Let's talk about inflation for a moment, because inflation is the reason the Fed often steps into aggressive mode. Inflation means your dollar buys less over time. Groceries cost more, gas costs more, rent costs more. When inflation rises too quickly, it erodes purchasing power and creates instability. The Fed's official target is usually around 2% annual inflation. Why not 0? Because a small amount of inflation encourages spending and investment instead of hoarding cash. But when inflation jumps to 5%, 7% or higher, that's when things get serious. To fight high inflation, the Fed raises interest rates. Higher rates reduce demand. People borrow less. Businesses slow expansion. Asset prices often cool. But here's the hidden tension. Raising rates too fast can push the economy into recession. And that's the tightrope the Fed constantly walks. Too soft and inflation runs wild. Too aggressive and unemployment rises. Now let's connect this to the US dollar's global dominance. When the Fed raises rates aggressively, global investors often move money into US assets to earn higher yields. That increases demand for dollars, pushing the dollar higher. A stronger dollar makes imports cheaper for Americans, which can help reduce inflation. But it also makes US exports more expensive abroad, which can hurt American companies that rely on foreign buyers. At the same time, emerging markets that borrowed in dollars feel pressure because a stronger dollar makes their debts more expensive to repay. This is why Federal Reserve policy doesn't just affect Americans. It affects Argentina, Turkey, Japan, Europe, and beyond. When the dollar surges, global liquidity tightens. When the dollar weakens, risk assets worldwide often breathe easier. And this is where gold enters the conversation. Gold is often seen as a hedge against inflation and currency debasement. When people lose confidence in fiat money, they turn to hard assets. But gold doesn't pay interest. So when the Fed raises rates and bond yields rise, gold can struggle because investors can earn income elsewhere. When rates fall or real yields turn negative, gold often shines. If you've been following the Gold Report for a while, you know we watch this relationship closely. Gold isn't just a shiny metal, it's a signal. It reflects trust, fear, inflation expectations, and real interest rates. When the Fed expands its balance sheet, as it did during major crises, liquidity floods the system. Asset prices rise. The dollar can weaken over time, and gold often benefits. Let's talk about quantitative easing, often called QE. This is when the Fed buys government bonds and other securities to inject liquidity into the financial system. It increases the money supply and pushes down long-term interest rates. QE became a major tool after the 2008 financial crisis, and again during the pandemic. It stabilized markets, but it also dramatically expanded the Fed's balance sheet. Critics argue that prolonged QE can inflate asset bubbles and widen wealth inequality because rising stock and housing prices disproportionately benefit those who already own assets. On the flip side, there's quantitative tightening, or QT. That's when the Fed reduces its balance sheet by allowing bonds to mature without reinvesting the proceeds, or by selling assets outright. QT drains liquidity from the system. It can put pressure on markets and strengthen the dollar. The transition from QE to QT is often delicate. Move too quickly, and markets react sharply. Move too slowly, and inflation risks remain. Another layer of this story is real interest rates. Real rates are nominal rates minus inflation. If the federal funds rate is 5% and inflation is 3%, the real rate is about 2%. Real rates matter deeply for gold and for long-term investment decisions. When real rates are negative, meaning inflation is higher than interest rates, savers effectively lose purchasing power in cash. That environment often supports gold and other hard assets. When real rates are strongly positive, cash and bonds become more attractive. But here's something most people overlook. The Fed doesn't control long-term rates directly. It influences them, yes, but long-term bond yields are shaped by market expectations of future growth and inflation. That's why sometimes you'll see the Fed raising short-term rates while long-term yields barely move or even fall. This can create an inverted yield curve where short-term rates are higher than long-term rates. Historically, an inverted yield curve has often preceded recessions. It's a signal that markets expect future slowdown. Now, imagine you're a small business owner. You see rates rising, borrowing costs increasing, and headlines warning of a possible recession. You may delay hiring, you may pause expansion. Multiply that behavior across thousands of companies and economic momentum slows. This is how monetary policy works through behavior, not just math. The US dollar's role as the world's reserve currency also gives the United States unique advantages. The US can borrow in its own currency at relatively low rates because global demand for dollars is strong. During times of crisis, investors often rush into US treasuries, seeing them as a safe haven. That demand supports the dollar. But this privilege also comes with responsibility. If confidence in US fiscal policy weakens, or if debt levels become a concern, pressure could build over time. Some countries have explored reducing reliance on the dollar for trade. They discuss alternative settlement systems and bilateral currency agreements. While the dollar remains dominant today, shifts in global geopolitics and trade relationships are long-term trends worth watching. For now, though, no other currency matches the dollar's liquidity, depth, and institutional backing. Let's bring this back to your daily life. When the Fed hikes rates, your adjustable rate mortgage could reset higher. Car loans become more expensive, credit card interest rises, savings accounts may finally offer better yields. The housing market may cool because fewer people can afford higher monthly payments. Stocks may become more volatile as investors reassess valuations based on higher discount rates. Everything connects back to the cost of money. When the Fed signals a pause or potential rate cuts, markets often react quickly. Stocks can rally in anticipation of easier financial conditions. Bond prices may rise as yields fall. The dollar may weaken if investors expect lower returns relative to other countries. And gold may gain if real yields decline. But here's the key insight. The Fed is always reacting to data. Employment numbers, inflation reports, wage growth, consumer spending, manufacturing activity, housing starts. Every data release can shift expectations. That's why markets sometimes swing wildly on what seems like minor news. It's not just the data itself, it's how the data changes the expected path of policy. At the Gold Report, we focus on understanding these shifts before they become obvious. We ask simple but powerful questions. Is inflation truly under control, or just temporarily cooling? Is the labor market genuinely strong or showing cracks beneath the surface? Are rate cuts coming because inflation is solved or because something in the economy is breaking? Because here's the truth. The Fed often pivots under pressure. Historically, aggressive rate hiking cycles have sometimes ended not just because inflation cooled, but because financial stress emerged. Banks feel pressure. Credit markets tighten. Something in the system strains. That's when policy can shift rapidly. And when policy shifts, capital moves. Investors reposition, risk assets reprice. Safe havens gain attention. This is why understanding Federal Reserve policy is not just for economists. It's for anyone who wants to protect their wealth. There's also a psychological layer. Confidence drives spending. If people feel secure in their jobs and optimistic about the future, they spend more. If they fear layoffs or economic downturns, they pull back. The Fed watches consumer sentiment surveys closely because expectations can become self-fulfilling. If everyone believes a recession is coming, behavior changes in a way that can make it happen. Now let's talk about debt. The United States carries significant federal debt. When interest rates rise, the cost of servicing that debt increases. That means more government spending goes toward interest payments. Over time, high rates and high debt levels create fiscal challenges. This dynamic adds another layer of complexity to policy decisions. The Fed is independent, but it cannot ignore the broader fiscal environment forever. And then there's the labor market. The Fed has a dual mandate: price stability and maximum employment. Sometimes those goals align. Sometimes they conflict. If inflation is high but unemployment is rising, policy becomes incredibly difficult. Tightening further could worsen job losses. Easing too soon could reignite inflation. These are not easy decisions, and markets know it. This is why every Fed press conference is watched around the world. The tone, the body language, the choice of words. Are they confident, concerned, divided? Markets interpret nuance, and sometimes markets force the Fed's hand. If financial conditions tighten too quickly due to market reactions, the Fed may adjust its messaging to stabilize expectations. Let's not forget the global backdrop. Central banks around the world also adjust their policies. If other major economies are cutting rates while the U.S. holds steady or hikes, the dollar can strengthen further. If the U.S. cuts aggressively while others remain tight, the dollar may weaken. Currency markets are relative games. For long-term investors, the key is not to panic at every headline. It's to understand cycles. Monetary policy moves in cycles: tightening, plateau, easing, stimulus, normalization. These cycles can last years. The trick is recognizing where we are in that cycle and positioning thoughtfully. Gold often acts as a mirror to confidence in policy. When trust is high and real yields are strong, gold may struggle. When uncertainty rises and real yields fall, gold can become a refuge. But it's not just about fear. It's about currency value over time. If the money supply expands significantly over decades, tangible assets often reflect that expansion. So what should you watch going forward? Watch inflation trends closely. Are they broad-based or limited to certain sectors? Watch wage growth. Persistent wage inflation can keep pressure on prices. Watch the yield curve. Is it steepening or flattening? Watch the dollar index. Is it breaking out or losing momentum? And pay attention to Fed language shifts. Small changes in wording can signal big shifts in direction. At the Gold Report, our goal is not to spread fear. It's to spread awareness. The U.S. dollar and Federal Reserve policy shape the financial landscape you live in. When you understand the game, you make better decisions. You're less reactive, more strategic. As we wrap up, remember this: monetary policy is powerful, but it's not magic. It cannot eliminate economic cycles. It can only influence them. Booms and busts have existed for centuries. The tools evolve, but human behavior remains constant. Greed, fear, optimism, caution. These emotions drive markets as much as interest rates do. If you found this breakdown helpful, let me know in the comments what topic you want us to cover next. Do you want a deep dive into gold price forecasts, a closer look at recession indicators, or an analysis of global de-dollarization trends? Your comments help shape future episodes of the Gold Report. And if you think someone in your life needs to understand how Federal Reserve policy affects their money, share this video with them. The more informed we all are, the stronger our financial decisions become. Thank you for spending your time with me today, and I'll see you in the next report.